Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Friday, February the 20th, 2026. Okay, so just very quickly, we have a little bit of data coming up this morning. First of all, yesterday's data, we had initial jobless claims and a few other things. Overall, fairly positive view of the US labor market. The employment situation seems to be fairly robust, as I said, fairly stable. This sort of, as people say, no fire, no hire sort of situation of equilibrium seems still to be holding. So the employment situation still seems to be good. And as I mentioned, I think in yesterday's video, I think that the Fed, for example, might start to put more onus, more emphasis at this point on the inflation mandate. So let's have a look today. We do have the core PCE now. Again, this is for the December period. So we're starting to get this. This started today is a little bit stale. We also have GDP of fourth quarter for 2025. Again, quite old data, quite stale. I don't know how market moving is going to be. However, the GDP will be kind of interesting just in terms of things like, real consumer spending. How is the consumer doing? Let's keep an eye on that. Obviously, the sort of GDP numbers in general is going to be interesting. And then, of course, probably the most important thing in a certain sense is the core PCE index, which is expected to come in at 0.3 is the consensus, previous 0.2. That, as we all know, the PCE is what the Fed likes to look at, the core PCE. That is the most important inflation metric. And just in view of keeping in mind some of the sort of speeches and whatnot we've been having from Fed members over the last few days, it does seem that the Fed is pretty much focused again on its inflation mandate and is showing some concerns, as were voiced by the FOMC minutes, which were released on Wednesday. So all that to say that in the absence of anything else, could we get a market reaction? Possibly. If the core PCE is very hot, what would that be? 0.4, 0.5 will probably sort of push down the front end of the bond markets for sure. Equities will probably not love that. On the other hand, if we get a sort of a strong GDP, that could be positive for equities, but not too strong. So again, the equities will want something which is, probably more or less in line. The equities will not want a super strong core PCE, nor will it want, I don't think, a super strong GDP. Just like steady economic growth is probably what it wants with a relatively tame PCE. We also get the S&P Global Manufacturing Flash for February. Now, this is a more timely, when I say number, it's actually a survey. It's not hard data. But that will be interesting. This morning we had the European PMIs, which were relatively positive. So that's going to be an interesting one to maybe just sort of flesh out, so to speak, the 8:30 data. So this comes in at 9:45. So the point is that by mid-morning we will have a little bit more information, a little bit of a sort of a sense of in terms of the sentiment and what's going on with the US economy, and that could give direction. The other thing happening today, we have option expiry. People talk about the morning expiries, the afternoon expiries of volatility. Because if we look at the markets, they have been fairly pinned in a low volatility, just sort of choppy trading range. So who knows, maybe today with the options expiring, that will allow the market to have less sort of pinning and whatnot. So that could be an interesting thing as well. Okay, so in terms of other stuff, what is also interesting is that today we may have the decision from the Supreme Court of the United States on the legality or otherwise of the tariffs. Personally, I'm not sure that the Supreme Court will come out with a decision today, but it's possible. So, is that going to be a huge market reaction? I would say not necessarily. Maybe a very short-term volatility, because at this point the markets had many, many, many months to digest the tariffs. The economy has digested the tariffs, and essentially what it seems to have done is to slightly increased prices, not hugely. So it's acted as a de facto sort of consumption tax in a sense, maybe 0.5%, 50 basis points, something like that. I think the market's fairly sort of immune. And why don't I think it's going to be a huge reaction? Because one thing I'd say is that if you just have a quick look here, we're not going to go through all of this, but you just see here, the point is that if the Supreme Court comes in and says that tariffs cannot be legal under the IEEPA, the Emergency Powers Act, as you can see here, there are at least 5 options which the White House administration can use to impose tariffs in some shape or another. And again, I'm not going to go through all of them. Feel free to do a screenshot. But you've got Section 232, 201, 301, 122, 338. These are all different sort of sort of legal measures that, the Trump administration can impose tariffs for, 120 days here, 150 days here, with congressional oversight, without congressional oversight. So the point is that the Trump administration will have studied all of this, and I expect that if the Supreme Court of the United States does come in and say, hey, they're more or less illegal, Trump, 2 minutes later will come out and say, hey, but we're going to put them, keep the tariffs on in other ways. So the first thing is to say that there are other mechanisms that the White House can use to keep the tariffs going. And secondly, kind of an interesting thing here from the Financial Times, basically looking at the effective US global tax rate. And you can see here in the blue, you can see here going back, when we had sort of Liberation Day. And again, not going to all the details, but what you can basically see in here is there's a whole pattern here of deals and sort of exceptions and exemptions and threats and taco talking things back. So, you see, say, oh my God, it's horrible. Then, talking it back and this and this. The point here is that if you look at the effective global tax rate, you can see that, people think it's going to be 20 or 30%, but it's probably coming back now more, towards, 10, 11, 12, 13, 14. And you see here that the actual effective rate, it's also been difficult to collect the tariff duties. And in fact, I was reading something the other day about a European manufacturer who said that they sent 5 batches of goods to the US, and they paid 5 different sort of tariff rates. So the point I'm trying to make here is that there are legal alternatives, number one. Number two is that the effective tax rate, sort of tariff rate, because of all of the compromises, shall we say, is nothing like at all which was announced on so-called Liberation Day back in early April of 2025. And this sort of rate of 9, 10, 11, 12% is something which, between the manufacturers, the importers, the exporters, the consumers, everyone's kind of figured it out a little bit, and it's not having such a huge effect. One thing I will say, though, could be interesting in the bond market. I find that quite interesting, especially the long bonds. One thing you can see here is that this is the government receipts from customs and duties, which is basically the tariffs. And you can see here from the beginning of the year, well, sorry, from actually going back, historically, you see it's all been down here. And obviously, since the tariffs came in, there has been, a fairly, massive uptick, up to sort of, billions of dollars. This is per month, I do believe. Okay. But that seems to be falling off a little bit. But the question is, for the long bond market, it's interesting because if the tariffs were ruled illegal, and in some sense we were to have less tariffs, I've already said that a lot of them will be sort of reassigned a legal sort of jurisdiction. But let's say we do have less tariffs. The problem for the long bond market is that the tariffs actually have been generating some income. And at the margin, not massive, but at the margin, that does mean a lower US deficit. So the US deficit is growing at a smaller rate because of the tariffs. So you could argue that the removal of tariffs is a negative for the long bonds because, technically, implicitly, that would imply that more sort of bonds need to be issued to sort of plug the deficit hole, which is a negative for bonds. So that'd be negative. On the other hand, one could argue that, this sort of de facto tax or slight inflationary sort of pressure of the extra tariffs, if they were to go away in some sort of shape or form, that could be at the margin a little bit deflationary. So again, these are quite marginal things. But I'm just trying to say, if anything, maybe there could be a little reaction in the long bond market. So that's that. Just gonna grab some tea. As I say, the possibility of the Supreme Court ruling today, it exists, but we don't exactly know if that's going to happen. Okay, so let's look at a few other things. We also had yesterday, it was interesting just talking about the Fed and whatnot, is that we had Mirren yesterday. We know that Mirren is the absolute sort of a dove. He's essentially Trump's representative on the FOMC. And it's kind of interesting that yesterday he said, "Oh, I don't know, the economy has been a bit better than I thought. The employment situation has been a bit stronger than I thought." So actually, he came out not so much as being super sort of hawkish or anything, but he says that maybe rather than doing 150 basis points of cuts in 2026, maybe only about 100 basis points were necessary. So it's interesting that, excuse me, that Trump's sort of mega dove, but even he has come out and said, "Oh, the economy is doing okay. Inflation is still a little stickier than I thought, and the employment situation is a little stronger." So that was interesting. And basically, what's happening, I want to show you some spreads here in the SOFRs, so the short-term contracts, short-term bills. is that essentially what the market is repricing in a sort of a hawkish way expectations for the Fed, and really it's sort of it's backloading, so to speak. It's pushing out the rate cuts more from 26 into 2027. So essentially, it's saying, okay, we're going to get some rate cuts, maybe a couple this year, 1.5, two and a half. The market currently pricing just over 2 cuts. But really, what it's doing, and you see this in the spreads, is pricing it out. So you look at this huge difference here. So if we look at the SOFR contract, so again, this is like the 3-month contracts for the secured overnight rate. So if you look at June 2026 with the spread of December 26, so that's like that 6-month period, you can see in the last, what's that, 5, 6, 7, 8 days here, the spread has blown out, it's gone down. And what is this spread? It's gone down about from minus 24 basis points to minus 36 basis points. So that's the differential in the between the front month and the back month. And essentially what that is saying here is that these the December contract is more dovish. It's moved by this much more dovishness compared to the front contract, so to speak, because it's moved in a negative way. So what that's basically saying is that the market has priced less cuts from the June to the December 26th thing, quite substantially. Then if you look at some other contracts, so let's look at, for example, June 26 to December, not 26, but December 27, you can see that's also moved massively. So you can see here that that's moved a huge amount as well. And then finally, if we look at something a little longer term, if we look at December 26 to December 27 spread, you can also see that that's all been sort of pushed further out in time. So what these spreads are telling us in terms of, what the market thinks the Fed will do and the SOFR contracts will do, which are very sensitive to Fed implications or imputations, is that it's basically saying, hey, maybe we're going to get some cuts, but the majority of the cuts, we're going to push them out into late 26, into 27. And that's what those spreads are telling us. So this is a good way of just keeping what the sort of market sentiment, this is what the market is really thinking about the Fed cuts, and more importantly, maybe the timing of the Fed cuts. So all of that to say that sort of the big picture is definitely sort of, I would say, more optimism in a certain sense on the economy, but it's tempered by a sense that the Fed will be cutting less. And maybe that explains a little bit just why the equity market, apart from all those other factors we've been talking about, has not been doing particularly well. Just quickly, if we have a look here at a couple of other markets here, you can see the VIX continues to remain relatively choppy and elevated. As I say, we do have the option expiry today, so on the 20th of the month. Maybe this will, allow things to be sort of taken off, but we still have a little bit of choppiness. I mean, it's not at massively elevated levels, 22, 23, but as I say, we're definitely not down at low. So still the market, we can't give the all clear. Oil volatility has started to skyrocket again, obviously because of the Iran sort of tensions. So you see here, oil volatility is up. If we look at gold volatility, that's not it's off its lowest levels, but it's off its highest levels, but still relatively volatile. And if we look at the MOVE index, which is bonds, that's also off its low. So point being, there's still a little bit of volatility. S&P 500 today, if you look at the price action for the last 4 or 5 days, essentially trading within a very, very tight range, choppy price action, waiting for some direction. And again, without belaboring the point, if we look over at the NASDAQ, same kind of situation here. What has outperformed a little bit is the Russell, slightly better, but again, still contained within small ranges. And again, just to look at all of the subcomponents here, you see that the equal weight, if anything, grinding a little bit higher. So not too bad. That looks like a very healthy chart from a technical point of view. If you look at the Mag 7s, I mean, one could argue, oh, it sort of had a little bounce off the 200-day EMA, but this is still, how can I call it? Maybe I won't call it weak price action, but let's call it subdued price action. And we really need to see some more energy. Okay, again, semiconductor, same thing, kind of like equal weight grinding higher, and the IGV, finding it difficult to pull up. And it's interesting, actually, I saw a chart yesterday, which I forgot to do a screenshot of, but essentially it was the institutional participation in IGV. And basically the chart was showing the balance between retail and institutional investment in IGV. And if you go back the last, I don't know, 5 or 10 years, it's very, very balanced. It's like tick, 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 tick. It's like a very, sorry, I don't have the chart, but it's like a very sort of a flat line kind of thing, essentially saying that, when retail participates institutions participate. When retail sells, institution sells, fairly much in balance. But what we're seeing in the last few days is a massive buying and participation, positive participation by retail, who are buying the dip. Every retail investor is looking at this and going, wow, that looks like a buying opportunity. But what we're seeing is a massive imbalance in the sense that institutions are not buying this dip. Okay, so the point is, I'm trying to make, at least from the data I was looking at yesterday, is that institutions, in the case of IGV, which is the broad tech software ETF, institutions are not buying this dip. They're not convinced. Where retail is participating. Take the conclusions you will. But I'm just saying it's interesting that this is finding it difficult to get off the mat. It's been beaten down, and it's the count is approaching 9 or 10 at this point. So to use a boxing analogy. So the point here is that it's finding it difficult to, as I say, to rally substantially. This is pathetic price action. In fact, there's no bounce here at all. And maybe one way of looking at that is to say that despite some retail excitement, sort of a buy the dip mentality, institutions are simply not buying it, to use a pun. Okay, what we have seen, so that is not great for that particular sector. What we have seen over in Europe is some relatively strong price action. There's some good earnings over there. So Europe continues to go relatively well. This is the Euro Stoxx 600. If we look at the Euro Stoxx 50, also doing pretty well. If we look at the German, not super amazing, but not as flat as, let's say, the Nasdaq or something like that. So again, just looking at a couple of others, you see the Bovespa over in Brazil doing well. So, emerging markets continue to do quite well. Let's have a quick look at emerging markets. EEM, also pretty good. So in general, those themes, a little, better performance from the rest of the world is continuing. If we look at, I just want to have a quick look, just in terms of the Iranian and whatnot. If you look at the 10-year, this is the ZN, you see here, a tiny bit of a reaction, but not really much of a safe haven bid, if anything. And you can also see, if we look at gold, gold is going up a little bit, starting to tick up a little bit. But remember that China is out because of the Golden Week holiday. Not a huge amount of safe haven demand at this point. If you look at silver, similar kind of thing, pretty flat, kind of grinding up. Okay, is this the beginning of something? Maybe, but still pretty flat price action. If you look over at copper, still stuck in a range, and BTC, nothing more to say, just, very, very flat price action. So the point I'm trying to make is that in terms of the Iranian situation, we're not really getting a huge safe haven bid in either the US treasuries or in gold, precious metals. Where we are getting a bit of energy is oil. Oil got to the top of its range, tried to poke its head higher on some of the bellicose rhetoric coming out of the White House. But as you can see this morning, it's reached that sort of recent high going back to the end of September. It popped above there, but this recent high from the 29th of January is proving a little bit of a sort of a top side just for the moment. And I think at oil at this point, we are Friday. Who knows? Maybe towards the end of the day, we'll get sort of going into the weekend a bit of a bid, but just sort of pulling back a little bit overextended, and essentially waiting for news. We know that yesterday Trump talked about, maybe sort of some kind of deadline of 10 or 15 days. The Iranians need to come to a deal. Otherwise, quote, bad things will happen. There's also been sort of rumors, Wall Street Journal reporting that the Trump administration is considering a sort of a small military sort of target, maybe even in the next few days, just to sort of jolt Iran a little bit, to say, hey guys, if you don't respond, we've got plenty more where that's coming from for a much more prolonged attack. Certainly the US is amassing sort of massive forces there, or very substantial forces. It's the biggest military buildup in that area since 2003. So the point here is that there is significant firepower there. Is this a negotiating tactic, a pressure tactic, or will Trump actually, who knows, over the weekend after the Winter Olympics ends, do some kind of precise military-based military target sort of attack, and then just to say to Iran, hey, this is what we need to be seeing, is some kind of sort of a deal on the whole nuclear situation and ballistic missile situation. At that point, of course, obviously, oil will have a short-term spike, and then it's going to be a question of whether we actually see real disruptions to oil supplies or some kind of sort of Iranian taco. Let's have a look. So I think just the oil market in flux at the moment. What we are seeing just in terms of a little bit of a safe haven is US dollar having a pretty good sort of few days. And it's interesting, just keep in terms of the safe haven. The US dollar does a lot better when oil is involved, just because the other safe havens, let's say, for example, the Swiss franc, but particularly, let's say, the Japanese yen and maybe even the euro, they are, of course, energy importers. And so when the oil price spikes, that is not great for, let's say, the Swiss economy in theory, but especially the Japanese economy and Europe. And therefore, their safe haven role diminishes somewhat when, we have geopolitical tension combined with potential for disruption to the oil market. So US dollar doing pretty well, on the strong data, on a less dovish Fed, and also maybe a little bit of a safe haven sort of bid. But as you can see here, we've got back to another critical level, which is the 61.8 fib retracement. You see here this fib retracement here, basically, which is a recent sort of overhead resistance as well at the 50-day moving average stalling out. So it looks as though that's sort of the line in the sand at the moment, 98 for the dollar index. And that's where we're at. If you look just quickly at the Japanese yen, that's also sort of weakening a little bit against the US dollar. If we look at the euro, weakening against the US dollar, but again, at a pretty key point. So US dollar's been doing pretty well, but as I say, equilibrium point, we have the GDP, even though it's a bit old from Q4, and we have the core PCE. Maybe that's going to give a little more direction this morning at 8:30. Okay, guys, I'll leave it there. That's enough for me for today and this week. I'll be back probably over the weekend, sometime Saturday or probably on Sunday, with a much bigger sort of overall sort of view of with a weekly market sort of overview from the macro shop. That's it for today. Have a great day. Have a great weekend. Thanks very much. Take care.